everyone. Can you see me? Can you hear me? Is everything okay? Let me know, please, in chat, maybe, if you hear me, please.
Yes, we see it here.
Yes, thank you very much. So let's start our lecture number 3, and today we will work with the topic valuing bonds and stocks. So we will repeat a little bit some basic terms and basic formulas and basic conception. And on tutorials, we will work with some practical cases, and based on the formulas, based on the knowledge you have from this topic, we will practice a little bit to apply these formulas, this conception of valuing bonds and stocks. Okay, so I'd like to tell you that the presentation, the lecture presentation, is in the folder studying materials in MS Teams, so you can follow me. You can open this presentation, and now I'm opening the presentation on my screen, so you can follow my screen also. Okay, so you can see my slides, valuing bonds and stocks. And our topics for today is valuing bonds, some terms, formulas, then interest rates, nominal and real, and differences, then valuing stocks and discussion. Let me present you basic terms from the topic valuing bonds. So bonds, I'd like to ask you, what do you know from this topic, bonds, what the bond is, what is the specific of this security, what do you know from your previous course, theory of finance? I hope that you have some knowledge about it, bonds and valuing, maybe some formulas, the application of these formulas. What do you remember from your previous course? Maybe you have some practical knowledge, some practical experience in working with bonds. So you may use microphone, you may use chat box as you want, as it's convenient for you. So the general definition of the bonds, very general, is that it's a security that obligates the issuer to make specified payments to the bondholder. So let me look through the chat box. Maybe you have some ideas? No. So, okay. So let's follow my slides again. And so the general idea is that it's a security, and this security implies that it obligates the issuer to make specified payments to the bondholder. The more wider definition is that bonds refer to the debt instruments, And this debt instrument can be issued by governments or by corporations for some purposes. General purpose is to acquire investors' funds for a certain period of time for certain purposes. If we are talking about the corporations, as a rule, as usual, it's investment purpose. And as for the bonds, these are fixed income securities. And these securities allow the bondholders to earn regular interest as a coupon payment. So it's the general idea of the bond. So we are talking about the two sides, the borrowers, issuers of these securities are borrowers, and bondholders are the lenders or investors. So the main bonds characteristics: issuer, face value, market value, coupon, coupon rate, coupon date. So let's look at these characteristics, and maybe you know about it, but we will repeat a little bit. Issuer, the company or government, and they issue debt instruments to borrow money for some purposes. Face value, or these are synonyms, par value or principal value. It is a payment at the maturity of the bond. Market value, price at which the bonds trade in the secondary market. So we have the primary market when we are issuing debt instruments. We do it firstly on the primary market, and then the bonds are trading in the secondary market. Coupon, the interest payments, regular payments made to the bondholder. Coupon rate, annual interest payment as a percentage of face value or par value or principal value is the same. And coupon date is the date at which the investors receive regular periodic interest payment. It is the coupon date. So what's more about bonds characteristics? Maturity date, yield, credit rating. So maturity date, it is the date the bond can be redeemed. So the maturity period can be short, medium, or long term, and it depends on you as the investor. It depends on the type of your investment strategy, investment portfolio. When you would like to sell the bond, so you can sell it before the maturity date. And today we will talk about a little bit about the investment strategy. Yield. It is the percentage return an investor makes by holding a bond to maturity. It's termed its yield. So then credit rating. Credit rating in order to know the risk level of the bonds, we use the credit ratings of some top rating agencies, for example, Moody's, Standard & Poor's, Fitch. So let's look at this scheme. It's an illustration of how it works. So we have investors, we have bond issuer, we have bonds issued. So we have periodic coupon payment, and our relations between the investors and bond issuer is about the borrowing. So the main purpose to borrow funds from individual or corporate investors for a specific duration. So in return, the issuer offers coupon to their bond holders. We have a lot of types of bonds. Bonds can be classified, so you can see on my slides the variety of bonds depending the rates, the coupon, and so on. And let's look at this example. This example is about the Nike and its bonds. And please tell me what do you see, what can you see on this slide in terms of bonds characteristics. What characteristics can you see from this announcement, from this information about the Nike bonds? So let me know about the main characteristics of these bonds. Okay, please.
Maybe the face value, final face value of all bonds.
And what is the face value? So we can see the information about the two types of bonds. So please.
So there are some difference. So we know about face value and par value. It is the synonyms, as far as I know.
Yes.
And
yes.
They are mean that the final payment to bond holder at the maturity day, like so. If we talk about the regular bonds, which has the periodical payment of coupons, and at the final coupon payment, we will get a coupon plus the par value.
Yes, you are right. And what can you see on this slide about Nike bonds, what figures?
Yeah, we can see the rate of the bond. It is the percentage of how much the interest of how much money we will get after the maturity date.
And what is the par value or principal value of these bonds? So Nike is offering two types of issue. So you can see it on this slide.
Yeah, we can see that there are 2026 notes and 1046 notes will be issued.
So it is the period of maturity. So, but the principal amount is before. So the first figure is the principal amount, then yield, and then maturity date. So maturity date. Okay, thank you very much. And let's check yourself. So we are talking about some characteristics of Nike's bond, and on this slide you can see some figures about these issues. From this information we know about the par value. So the par value is the amount of money that's paid to the bondholders at maturity. Then coupon payment, and from this announcement, from this information, we note that Nike's bond pays interest semi-annually. Then coupon rate is 2.375% in the first case, in the case of 1 billion offer, and as for the second one is 3.375 for the second offer. And maturity date, so we have the maturity date, and this is the following one. So November, 1st November of 2026, and maturity represents the date on which the bond matures, so the date on which the face value is repaid. And the last coupon payment is also paid on the maturity date. And we have this information on this slide. As for the first offer, it is the November 2026. Okay, thank you. And as for the credit ratings, it's the illustration of the different types of ratings of several credit agencies, credit rating agencies, Moody's, Standard & Poor's, and the meaning, the characteristics of these ratings you may see on these slides. And on our seminars, on our tutorials, we will discuss the theme connected with the default, the risk of default, and defaults concern the bonds. And we will discuss the Russian and foreign companies, foreign countries' experience concerned the default, the bond defaults. So in order to manage their investment portfolio, adjust their investment portfolio, we use also some indexes. And on my slide you can see these indexes that we use in order to make the investment decisions, adjust our investment portfolio, measuring returns, and we use the following bond indices by Bloomberg, Barclays, Citigroup, Merrill Lynch, JP Morgan Global Index. And as for the terms, when we are talking about the coupon rate, so when we are talking about the coupon rate, we mean that it's not the discount rate that we use in present value calculations. So the coupon rate and this term means that it is the information about what cash flow the bond will produce. What cash flow the bond will produce. And let's talk about the value in bonds. How to value bonds in terms of the price of the bond and what is the price of the bond. The price of the bond, it is the present value of all cash flows generated by the bond. And now we have mentioned before, when we have discussed the Nike and its bonds and the example of Nike's bonds, we have talked about the following cash flows. Coupons, it is the regular payments, and face value or par value and face value. And par value will be we will get it in the end when we have the maturity date. And let's look at the formula of the present value. It looks like the formula that we have discussed before in our previous lectures when we are talking about the present value itself in general. So our coupons and face value, these are our cash flows. Our coupons are our regular cash flows, and face value, par value, is our final cash flow in the end of life cycle, so-called life cycle of our bonds. So in this case, in this formula, the abbreviation CPN is for the coupon. So we have, we will use this abbreviation. And let's look at this example. It's a typical example when we are valuing bonds. In October 2014, you purchase 100 euros of bonds in France, which pay 4.25% coupon every year. If the bond matures in 2018 and the yield to maturity, so it is the abbreviation yield to maturity, is 0.15%, what is the value of the bond? So let's look at the formula again. So we have to use the coupon payment as a regular payment and par value. So we know these figures from our case. Always we imply that the par value of our bond is so in this case we know all these figures, and we have to just use all these figures in the formula, and we will get the answer. Present value is 160.34 euros. So it's just simple example of how could we use, how could we apply the formula for present value of our bonds. Then you know that our coupons, it's a regular payment. Regular means that we will get it on the regular basis, and it is the same amount of money. So we can use the formula for annuity. Annuity, it is the formula for regular payment of the same amount, and usually we use annuity for valuing bonds, for valuing rent payments, and so on. So our formula for present value of bonds can be rewrite in this way. So we can use both versions for calculating the present value of bonds. We can use this version of formula when we calculate the present value of annuity of coupons, and then we will sum up with the present value of principal. If we would like to use this type of formula for valuing bonds as annuity, we should use the formula for calculation of the present value of annuity. On our tutorials, we will discuss it in details, because we will start with the definition of annuity. We will repeat it because I know that you have discussed it before on your course Theory of Finance, but again we will repeat it, and we will rewrite this formula in order to get in details. In general, it looks like the following formula. Present value of bond, it is the sum of the following expressions. Our coupon multiplied by the present value of our annuity plus final payment. Final payment, it is our par value multiplied by discount factor. From our tutorial, so on our tutorial, we have discussed what the discount factor is. So we can calculate the discount factor for each year, for any period of time. And if we use both formulas, present value of formula of this type, when we work with the annuity of coupons, and if we use this formula when we are working with the discounting, we will get the same result. So it depends on the situation, it depends on your skills, your knowledge, but you can use any of these formulas, because all these formulas will get, by applying all these formulas, you will get the same result. Let's look at this example. If today is October the 1st, 2015, what is the value of the following bond? So imagine that IBM bond pays $115 every September 13 for 5 years, and in September 2020 pays an additional $1,000 and retires the bond. And the bond is rated AAA, and yield to maturity is 7.5%. So we can use the formula that implies that we should use the discounting of our regular payments, coupon payment, and the last cash flow is our par value plus our regular payment, coupon payment. And in the end of our calculations, we will get the following present value of our bond: 1,161.84. And we can try to calculate together what is the price of a 7.25% annual coupon bond with a 1,000 face value, and which matures in 3 years. Assume a required return or yield to maturity of 0.35%. So let's try to do it by yourself, and then in 3 minutes we will return and we will check your solution, your answers. So what's the price? It's a typical question. So we ask this question: what's the price? We imply that we would like to know about the present value of our bond. So what's the price of a 7.25% annual coupon bond with a 1,000 face value, which matches in 3 years? Assume a required return of 0.35%. So let's try to do it yourself, and then in 3 minutes we will come back and we will check your solution, your answers. You can write your solutions, your ideas in chat box, or you may use a microphone as you want. Okay, let's look at chat box. Maybe you can, maybe I have some solutions. So, and please, if you work separately and if you try to solve this mini case, if you try to ask this question, let's look at the solution. It is just discounting. We use the formula for the present value that implies that we should use the discounting of our regular payments, coupon payments, and then our final cash flow consists of the face value and coupon payment. So the present value is 1,205.56. And all these calculations can be made by using with the help of financial functions. We can use the financial calculator in Microsoft Excel, or you may use the financial calculator as you want, and we can use the special functions that use for that we use for the time value of money. So we can use the formulas for the special functions for maturity, yield to maturity, and special functions for the calculations connected with the present value. And of course, we have to take into account the time period. So we should use the same time period. Please pay attention because sometimes we should use the annual time period. Sometimes we should use the semi-annual, quarterly, monthly, and so on. So we have to take into account this information. So the same example, same as before. We can calculate using the financial calculators, using the special functions on these financial calculators, or you can use the special financial functions in Microsoft Excel. And on our tutorials, we will use it. We will practice it in order you can apply it in your further practice.
Excuse me, PMT, it is the coupon payment, yeah?
PMT, yes, it's about the coupon payment, regular payment. So you may use these functions. So N, it's a number of periods. I, it's a yield to maturity. Present value, it's our, we are required to find it. And payment, it's our regular payment, is coupon payment. And future value, it's our par value, face value. And please pay attention that sometimes in our calculations, when we use Microsoft Excel, we will get the present value with the minus. So we should ignore this minus, because it's just a sum of present value equaled 1,205.56. Then if we continue working with this example, the same figures. So the price, what is the price of 7.25% annual coupon bond with a 1,000 face value, which matures in 3 years, assume a required return or yield or to maturity of 0.35%. So if we are talking about the bond prices are quoted as a percentage of par value. So par value multiplied by price in percentage equals price in dollars. So we can get the price, bond prices, quoted as a percentage of par value. Based on these figures, we know the face value or par value, we know the present value. So we can calculate the bond prices quoted as a percentage of par based on our calculated present value. Then what's important to mention that sometimes we should use semi-annual coupon. So how could we calculate? How could we change something in order to use the semi-annual coupon? And what should be changed versus annual coupon payments. So let's look at the example, and I think you will understand yourself what can be changed in this situation when we have to use a semi-annual coupon. So let's look at the next example. In November 2014, you purchased a 3-year US government bond. The bond has an annual coupon rate of 4.25%, paid semi-annually. If investors demand a 0.965% semi-annual return, what is the price of bond? So what should we do in this case? What should we do, and what do you think? Looking at this solution, what can be changed if we are talking about the semi-annually base and this condition of semi-annual return? So what did we made in order to get the present value? What do you think?
Semi-annual means that we will get our coupons 2 times in a year, and we need to have our semi-annual percent. That means that we need to divide our annual percent by 2.
Okay, thank you very much. So you are right, and the logic is in this logic we should make our solutions. We should work with this logic. So we should use this logic in order to recalculate if we have to recalculate of our present value, use this semi-annual base.
Елизавета Igorevna, excuse me, isn't there an extra 0 in the denominator?
So we should use 0.965%, and we should divide it. And in this case, we use the figures, so not in percentage, but it's just figures. It's just figures. And what do you mean in your question?
How
you can check, and you can check this, and have you checked this solution? Have you checked these calculations now? No.
Not yet. how we need to calculate the denominators? So 1 plus 4.25 divided by 0.9, etc.
So we should use the following figure for annual return, semi-annual return. So we know the annual return and we should divide it by 2 in order to find the semi-annual return. So we should take our figure 0.965% and we should divide it, and we should find the semi-annual return, and we should use this figure for our calculations.
Okay, all right, thanks.
Sorry, but I not still understand why so many zeros.
Why so many zeros? Because we use not in percentage but in nominal. So we should use the following one. So let's calculate our cash flow for first year together. Okay. So for first year, what is the figure for cash flow? Cash flow, it is our annual coupon, but we know that our annual coupon will be paid semi-annually 2 times. So if we would use the annual coupon, we would get the following figure. So let's calculate it together. We know that our annual coupon is 4.25%, so 4.25%. So let's calculate our annual coupon based on this percentage. Our annual coupon rate is 4%, 4.25%. Our coupon payment is on the annual base is 42.5, 42.5. And if we know that our coupon will be paid semi-annually 2 times, then we should divide it by 2. So our final coupon rate, coupon payment paid semi-annually is 21.25. And then, if we are talking about the yield to maturity, we know that our investors demand 0.965% semi-annual return. But we know that it's semi-annual return, so we should divide our annual return 0.965 by 2. Let's do it together. So we should divide our figure for semi-annual return by 2, and we will get 0. And 4 figures after the 0, 4826. And then, of course, if we divide it by 100, so you will get the following figures: 0. Then 2 zeros after the 0, 4, and let's then I try to write in the chat box. Okay, why there are so many zeros? Okay, so we should divide our annual percentage 0.965 by 2. And then we will get the 0. And then if we use this formula for discount factor, so we have to use this formula for the discount factor. Of course, we should use the following. We should use it in the following way. And in the result, you will get the following figure. And about the coupon rate. So let's look at the coupon rate. On our conditions, we have the following figure. Annual coupon rate is 4.25%. 4.25% on usual face value. Usual principal is 1,000, and 4.25% par value. Thank you. And then if you know based on our case that our coupon paid semi-annually, so we should divide it by 2. So again, yes, you are right, Gleb. So we should divide it by 2, and our coupon rate is 21.25. It is our semi-annual coupon. Okay. So I hope it we will make it more clear for you, for all of you, on our tutorials when we will apply these formulas in different cases. And we will apply it on different bases, on semi-annual basis, on quarterly basis, annual basis, in order you could try to use it and you could compare it, because of course you need to practice a little bit in order to understand the difference, understand the specific of these calculations. Okay, let's move to our next slide. So don't worry about some maybe misunderstanding, because if you didn't practice before these calculations on different bases, semi-annual and quarter annual, we will do it, of course, on our tutorials. Okay, let's move to the next slide. So we will, we have discussed the basic terms, and now we are discussing the value of bonds, and we have discussed the general practice of using the calculations for the formulas for present value, the two types of formulas. And we have discussed the calculations based on the semi-annual coupon and semi-annual rate of return. And a rate of return. So if you remember our last tutorial, we have practiced a little bit to use the rate of return. In this topic, when we are talking about the value in bonds and when we are talking about the rate of return of bonds, we use the same logic. So the rate of return, it's the total income per period per dollar invested or per ruble invested. So rate of return, it is a relation total income to investment. So the logic is the same. We should find the total income. So if you remember in our tutorial, in our first tutorial, we have used the formula for total shareholder value. So now again, we will use this logic. We should find the total income as the sum of coupon income and price change. And we should find the relations, this total income to investment. And doing in this way, we should get the rate of return. So let's look this example. Bond increases in price from 963.8 to 1,380.50 and pays a coupon of 21.875 during the same period. What is the rate of return? So we should find the income, and income, it is the sum of coupon and the change in price. So we should sum up the coupon and the difference between the prices, and we should relate this income to investment. The initial investment, it is the price, initial price, it is 963.80. And our rate of return is 0.455. So in percentage, it's 45.5% rate of return. So we use the same logic, the logic based on the conception of total shareholder ratio, when total shareholder wealth, when we have to find the income, and in this case, our income, in the case of the bonds, income is the coupon and the change in price. And we should use the following formula: income to investment. And when we are talking about the bond, when we are talking bonds, when we are talking about our strategy, investment strategy, our investment portfolio, of course, we should take into account a lot of factors. And one of the factors, it is the bond duration. Bond duration. And bond duration, it is the very important term in this topic. It is a way of measuring how much bond prices are likely to change if and when interest rates move. So it looks like elasticity of bonds. In technical terms, bond duration is a measurement of interest rate risk. So it's about the very important question, interest rates and bond prices and relations between the interest rates and bond prices. The general logic of this movement is that rates, interest rates and prices move in opposite directions. So let's look at the example. When interest rates rise, prices of traditional bonds fall, and vice versa. If we are an investor and if we own a bond And let's imagine that's paying 3% interest rate. So yield is 3%, and rates rise. So our 3% yield doesn't look as attractive. It's lost some value in the marketplace. And that's why we should take into account the duration. And how could we measure this duration? We could measure, and duration could be measured by in years. And the logic is the following: the higher duration of bond or bond fund, if, for example, it means that the loaner we need to wait for the payment of coupons and return of principal, the more its price will drop as interest rates rise. For example, in general, for every 1% increase or decrease in interest rates, a bond's price will change approximately 1% in the opposite directions for every year of duration. Let's look at the following picture. It's an illustration, hypothetical illustration of the effects of duration. It is a percentage change in bond prices if rates spike 1%. For example, let's imagine if a bond has a duration of 5 years and interest rates increase by 1%, the bond's price will decline by approximately 5%. And if a bond has a duration of 5 years and interest rates fall by 1%, the bond's price will increase by approximately 5%. Why it's important? Why it is important to know the bond's duration if we are going to sell bonds before the maturity? So the first situation when it's important to know the bond's duration, if we would like to sell bonds before its maturity. Imagine the following situation: if we purchase a 10-year bond, yield 4%. For $1,000, we will still receive $40 each year, and we'll get back our 1,000 principal after 10 years, regardless of what happens with interest rates. If we do it in the end of our maturity period. But if we would like to sell our bonds before its maturity, then the price of our bond will be affected by changes in rates. And in this case, it's important to know the bond's duration. So it depends, and it's important to know the bond's duration before we make the decision about our investment portfolio. So in general, it's important to know the bond's duration if we are going to construct and adjust the investment portfolio. And we should take into account the bond duration when we are planning the construction of our investment portfolio. For example, if we expect rates to rise, so it makes sense to choose and to focus on shorter duration investments. So it's the logic, and we should take into account this logic in order to make the proper decisions, investment decisions. And this is the logic of changes in bonds and interest rate. And the term volatility is connected with the duration, with the changes in bonds prices and in interest rates. So it is the slope of the curve relating the bonds prices and interest rates. And we can calculate the volatility and percentage using the duration. And based on the change in bond price, change in interest rate, we also can calculate the volatility. And the logic is the following. Volatility is high at lower interest rates and low at high interest rates. So it depends on the movement. And also on our tutorials, we will practice to apply the duration and to apply the duration and volatility and to use these formulas. So we can calculate the duration, and duration can be calculated in years. So we have some examples in my presentation. And in details, we will use these examples. We will look at these examples on our tutorials in order to make it more clear and to understand in proper way how to use it. Yield to maturity, it's a very important term. Again, this term is connected with the bonds characteristics. And it is a complex concept, so we will use it as internal rate of return on interest-bearing instrument. And we will use it in the second way. It can be thought as weighted average of spot and forward rates, so that make discount factors that give the same present value. And on our tutorials, we will use the yield to maturity in several cases. Given the yield to maturity, calculate the price of the bond, and given the price of the bond, calculate the yield to maturity. So these are two types of cases, and in these cases we will use the yield to maturity and we will calculate it. And for example, this case, 1,000 treasury bond expires in 5 years. Base coupon rate of 10.5%. And what is yield to maturity if market price is 107.88? What should we do? We should build the cash flows based on these figures, and we should calculate the yield to maturity in the form of internal rate of return. So it is the second meaning of yield to maturity as internal rate of return of our investment. So this example and examples connected with the duration, I ask you to look through for the seminar to your tutorials, and on the tutorials we will calculate, we will solve some cases to understand how to apply in proper way these terms, yield to maturity and duration, because it's more complicated calculations. And as for duration and volatility, so of course it's connected with the investment strategy, with the type of investment you have chosen, and we will discuss it. We will discuss it in a more detailed way. And now let's look at the next question that is connected with the valuing of bonds and stocks. And often In our cases, we will use it, real and nominal interest rates. Real and nominal interest rates. And the general rule for us will be the following. We should calculate indicators using the same types of interest rates. If we should calculate, for example, the net present value in real interest rates, so we should use all our figures for in real using the real figures. And on the opposite, if we should use the net present value in nominal, meaning we use the nominal interest rates and all the figures for nominal, in nominal meaning, in order to meet this requirement. And as for the real and nominal interest rate, real interest rate is a theoretical rate you pay when you borrow money. And if we are talking about the movement of supply and demand, it's determined by supply and demand, and real interest rate cannot be observed. As for the nominal interest rate you actually pay when you borrow money, we can calculate all these rates, and we use the Fisher's formula for these calculations. So we use the following formulas in order to calculate the real rate and nominal rate, and recalculate if we have, for example, only real rates and inflation rates, we can calculate the nominal rates. For example, it's the short case which demonstrates us to how to apply these figures, indicators. If you invest in security that pays 10% interest annually and inflation is 6%, what is your real interest rate? We use the formula, Fisher's formula, and we can get the real interest rate using this formula, using the figures given in this case, inflation rate, nominal rate, and the real interest rate is 3%, 0.774. Or another case, if you invest in 5% coupon, 3-year Treasury inflation protected securities, and inflation is 3% each year, what are your real annual cash flows? So our real cash flows is the following one. So 5% coupon and 3-year Treasury inflation protected securities. Our final cash flow consists of our par value 1,000 and our coupon rate, our coupon payment based on coupon rate 5%. So again all these indicators, real rates and nominal rates, will be practiced on our tutorial based on different cases. And now we will start talking about the value of stocks, And let me ask you, what is the stocks? What are the stocks? And what is the difference between the stock and bond? I think that you know well about the difference between the stock and bond, and what is your idea? What is the main differences? What are the main differences between stocks and bonds? So you may use the microphones.
The main difference,
maybe the bond is a debt security and a stock is a share security.
Share, what do you mean share? Share of...
Долевая.
So you mean a share as a part of... the participation in the company's equity, maybe, yes? So
yes.
In this, okay. And what else? Maybe you know about you know something else about the difference between the stocks?
May I try, please? I believe that stock is a security that represents your ownership of some part of the company. And bond security from the part of company means that you have some obligations and you become a lender. And from the part of a person who buy bond means that you sort of a lender to the company.
Yes, you are right. So you are right. Your answers were right. Thank you very much. Excellent answers. In fact, really, a stock represents a collection of shares in the company, and it means that you're going to receive a fixed amount of dividend at the end of relevant financial period of time, financial year. And this is the fixed amount of dividend. It means that you are participating in the ownership. Sometimes it's called equity of the company, and bond, its term associated with the debt raised by the company and the conditions. So the debt raised by the company from outsiders, which carry a fixed ratio of return each year, so coupon payment, and can be earned as they are generally for fixed period of time. So we have talked about the main characteristics of bond: coupon payment, coupon rate, period of maturity, and par value. So the stock, it is it means that the person is making a contribution of capital. So the stock indicates owning a share in corporation, and bonds are actually debt or loans that are secured by a specific physical asset. And when we are talking about the stocks, we are always talking about the way of trading, and we know that initially we are going to the primary market, so the market for the sale of new securities by corporations. And if corporations are making the initial public offer, they are going to the primary market at first, then the secondary market. And on the secondary market, previously issued securities are traded among investors. And also we are talking about the different types of stocks, preferred stock, common stocks. And of course, on our tutorials, we will discuss different types of stocks in terms of portfolios, types of portfolios. We can use exchange traded funds and as the portfolios of stocks. Then we can use the different types of networks in order to trade the stocks. So when we are talking about the stocks, there are a lot of topics to be discussed. And as for the values and as for the valuing of stocks, of course, we should use the special terms. The book value, dividend, price per share, dividend by earnings per share ratio, market value balance sheet. So these are special terms that we will talk about, we will discuss it on our tutorials in order to use it in different cases. On this slide you can see the information about the common stock of General Electric and some information about the stocks for the certain date. And when we will use the term of value and the term of value of stock, again we will talk about the present value of its future cash flows. So it's this is the same situation, and we have mentioned before the value of bonds, and we have mentioned this present value and this logic. So again, we will use the discounted cash flow ratio, the discounted cash flow formula, and the logic will be the following. Our stock's value or present value of our stock will be equal expected future dividends. So present value of the expected future dividends. And the general formula for present value, it is discounted cash flow formula for the discounted cash flow. And also when we are talking about the stocks and value of stocks, we will use the expected return formula, and we will use the same logic as we have mentioned before when we have talked about the bonds. So we will use the expected return formula when we should find the relation our incomes to investments. And in our case, in the case of stocks, our incomes will be dividend plus price changes. So the same situation as we had before when we have talked about the bonds. And we should find the relation of these incomes to investments. And investments, again, in this case, will be the initial price of our stocks. Okay, let's stop here. And your task for the seminar number 3 will be the following one. You can find this task in the end of my presentation. Please read relevant chapters in the book Brearley-Myers Principles of Corporate Finance. These chapters concern about the value of bonds and stocks. In groups, prepare different examples of technical defaults concern bonds. So you may use Russian and foreign countries experience. And please prepare a comparative table, bonds versus stocks, in order we could discuss it on the seminars. And please look through all these slides, whole presentation, because on our seminars we will use all these formulas in order to apply it in different cases concern bonds and stocks. As I know, some information about the bonds and stocks you know from your previous course, Theory of Finance. So please look through all this presentation, all the slides, and of course on our tutorials we will repeat a little bit, and we will use all these formulas in our case. If you have any questions, I'm ready to answer.
Yes,
Is
please.
it homework for the third seminar or the second one?
This is our lecture is we have now third lecture, so we will work with these materials, bonds and stocks, on our third seminar. So I know that most of groups will have second seminar. So second seminar will be dedicated to the values, and the third one will be dedicated to the values, valuing of bonds and stocks. So you have some time to prepare for this seminar number 3, to look through this presentation, to read the chapters, and to find some examples of technical defaults and prepare a comparative table bonds and stocks to be discussed in our on our seminar.
A table should be prepared also in a group or individually?
In a group, I think it's more comfortable for you to work in groups. It's more convenient. If you are going to work individually, it's a normal situation, so it's not a problem. But on our tutorials, anyway, we will work in groups and we will discuss it in groups. So you can do it as you want, as it's convenient for you. But on our tutorial, usually we will work in groups, so we will discuss it in group format. Okay, any questions? Maybe you have any questions. If there are no questions, so thank you very much for being here, for participation, and if you have any questions, please let me know via email in MS Teams. You may write, of course. And see you next time, next lecture, next Friday, and see you on the seminars. Thank you very much.
Thank you. Bye bye.
Thank you. Bye bye. Thank you.